40x. Well, somebody sure seems to think so, and it's somebody that we know very well and whose opinion we really, really trust. Welcome to this week's episode of Shut the Fud Up. And as you can see, yes, I have a studio now because I'm going to be taking streaming a lot more seriously. You'll see that I'm not just on YouTube. I'm also streaming on Rumble, and I'm also streaming on X. You're going to see a lot more of me coming on up here. Now, something I want to share with you before we get started here today is that I've got a very special gift for all you guys that are watching today. Let's see, where do I have it? I think I got it over here. Yeah, right here. You see this book here? Today, I'm going to show you how you can get this book for free. It's called Your Parents Were Wrong. Outdated advice that they probably gave you. If your parents were boomers like my parents, well, then there's a lot of crap they told you that is just not true no more. So, you will be able to get this book for free if you watch this entire stream all the way up until the end. All right. Now, back to where were we here? Oh, yeah. All right. So, what I want to share with you today here. Oh, yes, Kirill, you will be able to get that book here later on today. Oh, yeah, another thing I wanted to get into right here. See, it's my new American Eagle shirt that I'm rocking because screw you, left-wingers. I love spending money on American Eagle specifically just to piss you guys off. And I sure hope that it pisses you guys off. I sure hope that you're pulling your hair out and setting yourselves on fire because, oh my God, you just can't stand Sydney Sweeney or any beautiful people for that matter. No, we can't have that. It's an absolute crime. It's an absolute sin. Well, too bad. All you're doing is just making me want to go buy some more American Eagle. And as long as they don't apologize, they have won themselves a customer for life. All right. So, another thing here is I think I've finally got the audio working. Everybody kept saying they couldn't hear what the chicken is saying. So we're going to do a little test here to see if it does work. This is the theme song for our program called Shut the Fud Up. And let's see, let me fix it right here, make sure that it works for you guys. Let me know if you can hear this.
Hey man, just want to let you know that sometimes you gotta shut the fuck up. You gotta shut the fuck up. And this current time is just one of those times you gotta shut the fuck up. I don't think you're a bad person. I just don't want to hear you talking anymore. You gotta shut the fuck up.
That's right, that's our theme song for this program, Shut the Fud Up. I think we finally got the audio working. I mean, yesterday, you should have seen like how much stress I was under yesterday trying to set all this stuff up here and get the studio ready. Like, it turns out that Rumble is where I had to go to get everything working. Because like every single other service out there wants a monthly subscription. They want to charge you $15 a month just to stream. Like, no, I ain't doing that. But you can stream to multiple platforms on Rumble. So we're streaming live right now on Rumble, on YouTube, and on X. Probably also start streaming to Twitch and to Kick. And everything so far seems to be running pretty smoothly. Everything seems to be working out pretty good. And it's awesome that it cost me absolutely nothing. Because I tell you what, man, I am just so sick of all these subscription services. And everybody saying, well, you got to pay $4.99 a month for this. You got to pay $15.99 a month for this. Like, to the point where your entire paycheck is consumed by subscription services. What's next year? We're going to have a subscription service pacemaker, and every single little thing that you have to live is going to be a subscription service. Like if you're an iron lung, they're going to have a subscription service for that. Oh, you didn't pay your iron lung, so I guess you just die. That's where we're headed, all right? That's where I see America going. But I have found the solution here to let me do a lot more streaming the way that I do it here. So as you can see from this studio and from all the lighting and everything, I'm going to be taking streaming a lot more seriously and try streaming a lot more. I want to say I'll stream every day. I'm not going to stream every single day, but I think I'll stream a lot more than just one day a week. I think I'll do a lot more of that here. And I'm going to be doing a lot more with the YouTube channel. I'll be putting up a lot of videos we'll be putting up a lot more videos there that are related to crypto or related to financial literacy, investment literacy, or just financial freedom and attaining it. I mean, as far as I'm concerned, it's all relevant. So you'll see a lot more being produced from me. If you're not subscribed to this channel, well, you're definitely going to want to get subscribed. You don't want to miss anything. Oh, thank you, Kirill. Yeah, this ain't too bad. It's a pretty nice studio here. So, some other things that we're going to cover here today is I want to take you through a bull cycle from start to finish to tell you how that works out. We want to talk about the interest rate environment and how that's going to play out here with crypto, because there's been a huge change in the interest rate environment. I don't know if you heard the news lately, but you're going to hear it today. Big change in the interest rate environment, and that definitely affects crypto and the big bull run that we're about to have. Still hasn't started yet, even though Bitcoin just posted a new all-time high and it immediately retraced from. Still haven't started the bull run yet. I don't think it begins until Ethereum goes over $5,000 or really $5,200. So we're still kind of in waiting and on edge. Might not get going until September, but you want to get your positions, you want to get your purchase orders in right now. What else I'm going to do here is I'm going to debunk a long-standing, frequently repeated piece of garbage that you probably heard a gazillion times this cycle, that, oh, we're not going to have a great bull run like before because there's just too many coins and it's saturating the market, which is the biggest pile of bull crap that has been spread this time around. It's absolute bull crap, and I'm going to show you beyond the shadow of a doubt that that's bull crap. And when you hear somebody spreading that kind of bull crap, I'm going to give you something that you could post right under their tweet to say, hey, stupid person, look at this. Your point has been debunked, so please shut the FUD up. I'm going to do that. But the first thing we want to do here today is talk about the subject of, can Ethereum do a 40x? Somebody that we all respect, or at least I think we all do, said exactly that it could do a 40x. And so what I'm going to do here is I want to play that for you. So let's see, where did I have it? I got it over here. Yeah. Y'all might remember this little exchange
cash, right?
between Richard and
I'm going to tell you a
big
quick
dumb
story,
doofus
right?
named Eric
quick
Wall.
Hypothetical. Ready?
Remember that schmuck? Yeah. I mean, he's not a stupid man, but he's a very dishonest and shrewd man, if he's even a man. I mean, judging from the way he's dressed right there, I mean, that is like some of the strangest attire I've seen. Like, people criticize Richard Hart's attire, but look at Eric Wall. And look at that hair. Goodness. Now, he is not a stupid man. He is a smart man because he knows what I've been preaching for the past several streams, and really ever since I got into this business here of streaming, ever since like I started addressing the PulseChain community. He knows it's all based on the debt cycle. That's why he made bets with all these hexagons. That's why he kept upping the ante with all those hexagons. And that's why he won those bets with all those hexagons. You see, some of these hexagons that are making the bets and everything, they were just like, whoa, it's just going to go up because, Richard Hart said it's going to go up. He didn't say when. And they all failed to understand the debt cycle. And I'm pretty sure Richard explained it in one of his streams. But here is a exchange that has come to light recently. It definitely stands out to me. Like perhaps, this was many years ago. I think it was back in 2022. This was Richard subtextually telling us what it is he's going to do with PulseChain. So let's play this. Let's hear this. See, do I got the volume on it all the way up? Yeah, I do.
I'm going to tell you a quick story, right? I'm going to give you a quick hypothetical. Ready? Let's pretend you launched a coin and you raised money, right? And then you put that money into Ethereum. And then Ethereum went up 40x. And then you dumped that shit, right? And then you had like a fucking stack of cash, right? I bet like if you reinvested in your original coin, you could have actually net put more into that coin than you took out. Do you know what I'm saying?
No.
No, you don't get it. Okay. Well, I can't say it any more clear. I'm gonna.
Man, I miss that man. So, you see, the idea here is that he is taking money that he raised to start his chain. That's the PulseChain sacrifice wallet. Investing that into Ethereum. Ethereum has a great big run. He sells the Ethereum and then puts the capital gains into his coins, which we all kind of think that he was going to do anyway. But it turns out, yeah, this may have been his plan all along here, was to do precisely this. Let's hear it again.
I'll tell you a quick story, right? I'm going to give you a quick hypothetical. Ready? Let's pretend you launched a coin and you raised money, right? And then you put that money into Ethereum, and then Ethereum went up 40x, and then you dumped that shit, right? Then you had like a fucking stack of cash, right? I bet like if you reinvested in your original coin, you could have actually net put more into that coin than you took out. Do you know what I'm saying?
No.
No, you don't get it.
And of course, Eric Wall doesn't get it because he's like, no, he does get it. Eric Wall does get it. He's not a stupid man. He's just a very dishonest man. This is him being dishonest and going, oh, no, I don't understand. You get it, Eric. I know you get it. So, this is just him being a putz and not wanting to give a shred of credit at all to Richard, as always. He never wants to do that. But, you know what? Screw him. We don't need him to like us for our ecosystem to work out just fine. Like, we're much better off without him. And, oh, yeah, nice. So it looks like our stream here on X is working just fine. Man, I'm really liking this Rumble thing right here. I don't understand why YouTube couldn't do this, why they couldn't have a simple button you click here. Stream to YouTube, stream to X, stream to Twitch, stream to Kick. They couldn't have that. No, that was just way too much to ask for, so I had to go all the way over to Rumble. Some other things, though, that stood out to me that I wanted to share with you all here. So you got to find out where did I put it? Where did I put it? I'm going to put it somewhere. Oh, yeah, this thing here we're going to get to later. There was another chart. Yeah, this tweet here from Cryptico. Don't know if you saw this, but if you haven't, let's say take a look at it here. Let's check this out. He says, pay attention to the vertical blue line. Do you know what that is? It's when Richard Hart called the top in 2021, the Bitcoin top. That was right here. After Bitcoin topped, that was in May, the May top, the first one. After Bitcoin topped, that was when Hex had its 10,000x run. So pay close attention to when Richard calls the top. Because the thing with Bitcoin topping, it tops before any altcoin ever does. Tops before any altcoin ever does. And then what happens is the alt season starts, and Ethereum outpaces Bitcoin for a whole 6 months. So all these people that are Bitcoin maxis like Max Kaiser that are going, oh yeah, look at us, we're so great, we were right all along because Bitcoin is the only thing going up. No, it's not over yet, guys, because this is the way that it's always happened. So you can go ahead and talk all the trash that you want right now, but there's going to be 6 months where Bitcoin is pitifully underperforming everything else. It's coming. And not only will Ethereum be outperforming Bitcoin, but the rest of the crypto market as well is going to be whooping its butt. So brace yourselves here when that happens. Man, I think that it might get running in September with the first Fed rate cut here, which is what I want to show you next here, because that is a news story. Let's have a look here. Well, before we get into rate cuts, let's take a look at the usual stuff. Look at the usual stuff here. Let's see. I'm going to share this here with you. Just share the whole window and pull that up. All right. So, where's Bitcoin at here today? Well, it went up to 124,000, then it retraced down $6,000, but that's okay. I mean, this is very common, and really the amount that it's down is only about 3.7%. Nothing to worry about, at least not yet. What has got everybody disappointed is how Ethereum, it almost went up to its previous all-time high of 4,800, then it came back down to 4,500. Guys, as long as this thing is holding above 4,500 or it's staying within 4,000, we're in good shape right here. This is not bad. Some of the altcoins that I like here, I'm keeping a close eye on Kronos because that is one of those penny coins that I keep talking about, my penny coin strategy. Another one that I've been looking at lately, and I've been keeping a close eye on, is Root, because that one's gone down quite a bit from where it normally been trading at. But yeah, here we can at 0.003 cents, or at 1/3 of a cent practically. It puts you in a position to make very good asymmetric purchases. And when it comes to the Richard Hart ecosystem, well, we don't really want to look at it on CoinMarketCap because they usually get it wrong. We want to look at it on gopulse.com. And here's what I like to see here is that Hex, despite all of the volatility, has held above 1 cent, the PulseChain version of Hex. That is something to celebrate. That is something to be grateful for, that this thing has stayed above 1 cent despite all of the chaos and all of the volatility that's been occurring lately. And what kind of chaos and volatility are we talking about? This is what I'm talking about. Check out the bond market and the interest rates. Matter of fact, let me refresh it, make sure I got the latest data. It's like bond market's closing a little bit. And what do we have here? Well, notice this line right here. This is the line that matters the most here when you look at this, where it just says U.S. Treasury. What does this say here? What's different about it than from previous times we've been looking at it? Everything from 1 to 5 years is now less than 4%. Now, really, the 10-year Treasury is what matters the most. That's the one that we pay the most attention to. But look at this here. Every type of Treasury leading up to the 10-year is now below 4%. And these like real short-term ones over here, 3 to 6 to 9 months, they're going to be below 4% pretty soon too. I mean, the 9 months has just got one tick to go here before it does. After it ticks down just a basis point, it's going to be below 4%. And same with when that one goes, the 3 and the 6 months go too. But here's the thing. It's kind of like the wrestler Goldberg. Remember back in the 90s? And everything was better. Well, one thing that was definitely better among the everything that was better was wrestling was way better back in the 90s. Goldberg was going through guys left and right. He was just ramming through them and destroying them. Kind of think of it as like Goldberg has been going through all the treasuries. At first he took out the 1 year, then the 2, and then the 3, and then the 5. Coming up next is that 10-year treasury. And how do I know this? How do I know the 10-year treasury is going to go down? Here's how. Because what is the treasury market doing right now? It is pricing in a rate cut that the market believes is going to happen. See, this is the FedWatch tool from the CME. They are now pricing in a 92% chance of a rate cut. They think it's just going to be 25 basis points. That's what it is right now. We still got a good 33 days before this meeting actually occurs. So it could possibly be a 50 basis point cut. It could be a 0.5% cut that they do. And if that's the case, we're gonna have like an amazing run here when that happens. But not only are they doing that for September, not only is that being speculated and priced in, but They're also pricing one in here in October. Still, it's way too early kind of tell for October, but they are thinking it's going to happen. And then December, they think another one might happen. Not the majority yet, because it's just way too early to tell. And like this one here in January, that's way too early to tell. Those numbers mean nothing. But 30 days out from a Fed meeting, they think there is a 92% chance of a rate cut. That is great news. That's the effect of that on the DXY. That's one of my rivals' claims doesn't matter, even though the charts and the data prove me right every single time. Right now, that dollar index is still very strong. The purchasing power of the U.S. dollar in comparison to the basket of goods that they hold it against here in the Dixie, and a basket of currencies, foreign currencies. That's what they use the most here in the Dixie. It's still very strong. So we really need this thing to come down to 93, 92, which it will. It will here when the interest rates go down. Because you see, what's making this dollar so strong is the fact that I can take a dollar bill and go invest it over here and get almost 4% in 1 year. That's how this is all interconnected. Why is the dollar bill strong? Because it can get you 4% in a year. And it's not just, I don't even have to invest in a treasury. I can just put it in a savings account, and that savings account is going to be invested in treasuries by the bank. All right. Let's see, was there any special stories here from the financial press? I don't think so. Really nothing that, oh wait, what's this here? Potential Fed chair pick David Zervos of Jefferies backs aggressive interest rate cuts. Okay, you know what? Let's check that out. That sounds interesting. Anything else here? I don't really see anything else very interesting here to me. So, get into this here. All right. Potential Fed chair pick David Zervos backs aggressive interest rate cuts. That's good. We like interest rate cuts. We like aggressive interest rate cuts. For the past 3 Fed meetings, Zervos has advocated a 0.5 percentage point cut in the federal funds rate, and he repeated that position during the CNBC interview. Okay. So, we don't know that this guy is actually going to be the pick, but if he is the pick, he is going to be backing very aggressive interest rate cuts, and that's good news for us. It's good news for crypto. Yeah. As the other thing we want to talk about is the inflation chart. Probably come back to this later here because I got some stuff to say here about the inflation report. So we'll get into that a little bit later. Let me get back over here and fix that. All right. Oh, well, hello, Johnny. And hello, Tam Tam. Good to see you guys. I guess with Johnny Chaos here, the thing is, it's like Beetlejuice. If we say Chaos 3 times is when he appears. I think that's how it works, right, Johnny? Okay. So, first thing I want to do here today is debunk a very strong piece of FUD. A very strong piece of FUD that all of the bears are repeating constantly, and they just never shut up about. I'm going to give you guys something that just destroys it. Absolutely destroys it. Let's talk about that here. I call it the dumbest crypto myth that everybody keeps repeating. See, you probably heard this one a million times. Well, yeah, crypto had a good run in 2017 and 2021, but this time is different. There are just too many coins, and it's all diluted now, and the market can't pump like it used to. And that is exactly how these bears sound. And every time somebody drops this gem, a finance god is just weeping into their Bloomberg terminal with their tears, smudging up the charts like they would strippers' makeup as they lament the illiteracy of the bears that say this. Because the too many coins argument It's some of the dumbest myths in the space here. It's like this one myth that just refuses to die. And here's why it's stupid. They think that, well, a coin market cap lists over 1 million crypto assets, and every loser living in his mother's basement creates their own meme coin that they're going to later rug, and that number grows faster than weeds in a neglected garden. And the market is supposedly spread too thin for those glorious moon-bound rallies of yesteryear. Oh my. Well, here's the problem with it. 99% of those coins, you can think of them as being like the forgotten extras in a Hollywood blockbuster. They may as well not exist in the eyes of people who actually bring new money to the game. I'm talking about new retail investors are going to be bringing in new money. Institutional whales who drive the market. You think that they're going to be looking at 99% of those coins? No, because 99% of those coins are not available where 99% of the new money that actually drives the market up comes in. New money comes in through centralized exchanges or to the institutional over-the-counter market makers. New retail money doesn't wander onto Uniswap or Pump.fun or CowSwap to buy some obscure ERC20 or a Solana meme coin that launched last Thursday with a liquidity pool smaller than a lemonade stand's cash drawer, probably manned by a kid. No, it goes to centralized exchanges. It goes to Coinbase, to Binance, to Kraken, and they don't list that crap. And the same with the institutional buyers. You think that they're actually getting on Pump.fun and taking any of that crap seriously? Because that's where the majority of these new coins are landing, is on Pump.fun. You think that an institution is going there and taking any of those coins seriously? No. You can think of it like this here. It's like, I think way back to the olden days when we had malls. Remember those good old days? I don't know if we still have those anymore. Maybe we do. I don't put too much attention to that. But you have real big stores at them. Well, think of those as like, the old ones, like be like Sears or J.C. Penney or Dillard's. Those are the really big department stores. You'd have those. Well, think of that as like Bitcoin and Ethereum. That's right. Bitcoin and Ethereum are the real big ones out there. And the teeny ones, though, those would be the coins that are the new ones coming onto the market. And you know what they are like? They're like the rickety little stalls that are right in the center of the walking spaces that are selling knockoff trinkets that barely get a glance. That's what they're like. Okay? Because you see, when you go to CoinMarketCap as a new investor, they barely look past the first page. They probably never look past the first page. It's just like when you search for something on Google. The search engine is going to return thousands of results pages to you, but do you ever look past the first one? No. Most people don't even look past the fourth result on the first page. So you see a headline like, 4,000 coins launched this year. Well, you're not looking at 4,000 new competitors to Bitcoin or Ethereum or even the top 100 coins. You're looking at practically 3,999 irrelevant coins, vaporware, rug pull fodder, or microcap dreams. Maybe one of those could one day have a fight for a seat at the grown-ups table. But most of them, no. They're absolutely nothing to worry about. I mean, it's like thinking the creation of thousands of no-name penny stocks trading for cents on these obscure OTC exchanges or the pink sheets. Those had zero effect on Apple's price, on Amazon's stock price, because those juggernauts were the place institutional investors would park billions of dollars. Penny stocks are the noise. Or it's like saying, well, more trailer parks is going to hurt the mansion market. Yeah, there are a lot more trailer parks today than there was in 1990. But you think that that's hurting the 10-bedroom Beverly Hill palaces? No, it's not. So, why do people, here's another example here is, if anything more assets in a sector can grow the market, because that's what happens in the bond market. I mean, there are more treasury bonds today, municipal bonds, corporate bonds, and even junk bonds in existence today than at any other point in history. It's a debt pile that could bury entire continents. Has that diluted the bond market any? No. It's expanded, actually. I mean, I showed you last week how every time they increase the amount of treasuries that they're issuing, the money supply is increasing to match it, and GDP is increasing to match it. It gets absorbed. There are control systems for this already. All it did is it's expanded the bond market and the people that are investing in it. Because more variety just means more total money flowing into bonds overall. So the same thing would happen to crypto here. So the people that say this, like, what's their motivation? Well, one, they're probably investment illiterate. That's one possibility. Or two, they're looking to spook you into sitting it out until they've loaded up and are ready to sell you at a premium. You know what they call it. They want to make you their exit liquidity is what it is. Or third category is they're just stupid and they don't understand why the bull market hasn't gotten started yet. And they're too stupid to understand the debt cycle and how that plays into it. They don't understand that. So they just got to say something like, oh, it's because it's just way too saturated. It's just like, man, when I worked in TradFi, if you ever got asked a question that you didn't know the answer to, well, what you would just do is you would just say, China. Yeah, China. China's the answer. Why is the economy bad? China? Oh, okay. Hey, why is unemployment so low? China? Oh, okay. Because you see, like, it's specific enough, but also vague enough to cover everything. Yeah. Here's here's what I want to give to you in order for you to smash this FUD whenever you see it. I'm going to share my screen here with you on that again. Where do I have it? I have it right here. This is my Substack. It's reinventideal.substack.com. And so far, everything on there, all of the articles that I've written are 100% free. 100% free. And this is what I was reading from. Was one that I wrote earlier this morning. The dumbest crypto myth everybody keeps repeating. This here is the Reinvent Ideal Substack. Come check this out here. Subscribe. And we'll talk more about this here later. But I'll tell you what, I'm starting to love this Substack thing here, because this, I think, could replace YouTube. I think it could really give YouTube a run for its money, because this doesn't have any of that censorship or any of that gatekeeping. Like, if you wanted to get into being a content creator, I would start with Substack, because it is growing in popularity. It's really become a thing. It's really getting to become a big thing here. It's got very low barriers to entry, and it's very easy to use. I mean, think of it as like it's as good as OnlyFans, but without the porn. Like, this here would be for serious content creators, not for a bunch of slutty thoughts that want to just show off their body and take the easy way out. Like, if you want to share ideas in long form, and if you're a good writer, this is really going to be the place for you guys to go. And they also do video. They do podcasts and everything. I'm using it just for writing right now to kind of like scribble out my ideas and get them into print. So at my Substack, reinventideal.substack.com, that is where you will find hopefully a new piece every day. I can't really promise I'll have one up there every day. But I got a lot of stuff that's in draft mode right there that I'm working through slowly. So you will not regret subscribing to this. I promise you. You'll at least be entertained by what you read, if not educated. So that was something that we want to share with you here today. Now, going back to like the thumbnail, is a 40x in Ethereum possible? Well, Richard said that in his debate with Eric Wall. And I tell you what, like, Richard is very careful with the words that he uses. He's very careful with them. He doesn't just say these things. So it's possible that he meant a 40x from the price it was at then, which was, I think, just $1,000 back then, or maybe $1,200. So are we looking at a $40,000 Ethereum? Oh my goodness! If that's the case, that would be amazing, amazing for Hex holders. Absolutely amazing. Like, first off, Hex, the ERC20, that thing would be like $20 if Ethereum was at 40,000. And then if he really does sell the profits from the Ethereum run and pushes those profits into buying the core coins on PulseChain, I don't even know if I could come up with a price prediction on that. I don't even know what the ramifications of that would be. So if that did happen, oh my goodness, man, that would be absolutely amazing for us here. It'd be like one of the most incredible things that we'd see. Hey, notice that Richard has been tweeting up a storm here lately. And there's one tweet that really stood out to me here I wanted to kind of go over with you guys. It was this one, where he points out that the PulseChain Foundation, or the PulseChain Sacrifice Wallet, I should say, PulseChain Sacrifice Wallet, is just underneath the Ethereum Foundation. Why is that significant? What's the deal here? Why am I pointing that out? What's so good about that? And I'll tell you, like, here's what I'm hoping happens. I mean, I don't want to say I'm hoping this happens, but you know what the Ethereum Foundation does with their ETH is they dump it. They dump it on the open market, screwing over so many of their holders. What's the margin between the Ethereum Foundation and PulseChain SAC Wallet? It's not that much. I mean, really, when you look at it, it's only about maybe 60,000 Ethereum there in between the two of them, or maybe 65, about 65,000 Ethereum. You know, it'd be cool is like if Ethereum, the foundation, dumped, say, 70,000 Ethereum, and then the PulseChain SAC wallet bought it all up. That would mean that we have a bigger stake in Ethereum, or PulseChain has a bigger stake in Ethereum than the Ethereum Foundation. That would mean the PulseChain SAC wallet is holding up the market and supporting the bull run, the monumental bull run that we're about to experience. Everybody would have to thank us for being the best hodler of Ethereum, better than the Ethereum Foundation. I mean, look at this here. What it shows is like the Ethereum Foundation's actually at a loss for the past 30 days, and that's because they're constantly dumping. It's hilarious. I mean, it could happen here where PulseChain could pass the Ethereum Foundation. I'm kind of I don't really want the foundation to do any more dumping. I don't like it when they do that, but I do think it'd be cool if the PulseSac wallet had surpassed it. All right. So moving right along here. So while Ethereum is going up, I mean, it's down now, but it was going up. What's going down right along with it? Interest rates, and specifically in the Treasury market. Yeah, you know that thing that I never shut up about? Yes. You see, I have in fact been right this whole time. Go ahead and watch my previous streams. You will see everything I've been talking about has been 100% spot on. I've been right this whole time. You don't need to watch any other crypto streamer but me. Because I don't hear any of them talking about the debt cycle. I don't hear any of them talking about treasuries. I don't hear any of them talking about the central bank money printing. But interest rates have been tanking, and pretty big time right here. Like, you know, they just heard that the economy's got a terminal diagnosis. That's how they're acting with these treasuries. Comes hot on the heels of this week's CPI report that says inflation was 2.7%, not the 2.8% that was expected. So, have a look here at the CPI reports. Let me bring that up here. Where did I have that? It was a CNBC story. Yeah, here it is. Okay. So let's take a look here at how this is going. It says that eggs were up the most here. I noticed that one, yeah. That eggs, I used to be able to get like a big box of them for a much cheaper price than what they're at right now. Roasted coffee. I don't drink coffee, but man, this beef steaks, that really hits me hard, and the ground beef and everything. God, it sucks. And none of the food is down. I mean, like usually you'd see like, well, there's some foods that went down in price. Not this time. So the groceries, they have gone up. And this is not good, y'all. Does not look good at all. It's what I keep saying is like, hey, we really are in a recession. It's just like back in 2022, they don't want to call it one. So the 10-year treasury, the swan dive, gold, crypto action, this is all connected here. We're going to connect all of these dots here today with my favorite subject that they don't teach you in schools. Anybody want to take a guess at what that is here? Something that I talk a lot of trash about. Oh, thank you, Sean. I appreciate that. My favorite subject that they don't teach you in schools is investment literacy. That's right, investment literacy. And by the way, that is going to be the direction of this channel, is financial freedom and investment literacy. Because I tell you what, like even in my coaching business over at reinventideal.com, I was getting several questions about financial freedom and financial literacy ever since I started streaming but you guys about crypto. And more so than the usual question I get. You know what the usual question was I'd get? It'd always be like, Cairo, how do I get the girls? Which isn't the question they're really asking. It sounds like, oh, how do I get the girls? That's not the question they're really asking, though, because you see, what they're really asking is, how do I get the girls without having to do any work? Because when I start answering the question and I tell them, well, you're going to have to do this, you're going to have to do that, you're going to have to do this, blah, 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 blah. They're like, oh, how do I do that? That sounds like work. Well, then I guess you suffer. Then I guess you don't get the girls then, because that's what it takes. And then they get all pissed, which is why I always charge up front for my coaching sessions. So I'm getting tired of answering those questions. I'm getting tired of that customer. I want to focus more on financial freedom and literacy. Because I'll tell you what, like, can any of you guys, like even you single guys out there, can any of you even afford to date? Not with this CPI that I'm seeing right here. I don't think I wouldn't want to be dating right now. Let's go back to that. Where's the CPI here? Look at that. Food away from home. Look at that. Let's see. Full service meals are up 4%. I don't know if they're really talking about. I don't know if they're talking about restaurants or anything. I would imagine that they'd be talking about restaurants, but is that somewhere on here? Nah, doesn't really seem that way. But hey, take a look at this stuff right here. This is not a time where I'd want to be dating because you can't even afford to. So I think what's going to help all you guys out there a lot more is for me to focus a lot more on financial freedom and financial literacy. And as you can see from the new studio here, and you'll see from the channel, I'm just going to start taking YouTube a lot more seriously. I might stream 3 times a week or something, or at least I'll stream more often than I am right now. I'm thinking like, hey, how about on Mondays we do like Macro Monday and cover macroeconomics? And then on Wednesdays, we'll make it like Reaction Wednesday, where I react to something, or maybe call it Woke-Tard Wednesday, because I really love making fun of the woke-tards out there. And then Fridays will be Shut the Fud Up Friday, or maybe keep it on Thursday, Shut the Fud Up Thursday, where we cover things like I'm covering right now, telling people, hey, shut the fud up. So, back to where we were here. Where was I? Oh, yeah, the 10-year treasury, it is down a little bit. It's not down as much as it was before. I mean, it was down to like 4.22, but it's down a little bit here, and it's a pretty chunky move for a single day. Because you see, after the non-farm payrolls disaster, where only 73,000 jobs were added, which was way below the 109,000 that were expected. I mean, you got you also had like a 258,000 downward revision in May and June. That caused that 10-year treasury to drop 20 basis points. And then the 2-year, that fell even harder, 25 basis points. This is what we call a bull steepener in TradFi. And I want to show you exactly what that looks like here. I got something over on the Fred website. Where do I have that? Where's Fred? You can call it like the yield spread. See, this right here, what this does is it shows you what is the difference between the yield that you get on a 10-year treasury versus the yield that you would get on a 2-year treasury. Now ask yourself that in a logical world, you would expect a loan that you make for 10 years to have a higher interest rate than a loan you make for 2 years, right? There's more risk because more can happen in 10 years. And throughout most of history, that had been the case. And up here, this was 2021, sorry. Remember when times were good, 2021? Yeah, I remember that. We had that logic going for us. They call that a normal yield curve or an uninverted yield curve where the spread makes sense. But then, as we got deeper into the bear market of 2022, look what we had here. This was what we call an inverted yield curve. This meant that the 10-year treasury yield was a whole percent lower right here on March the 8th. I remember it was March the 8th, 2023. March the 8th. I guess you could kind of say that really was the bottom for a lot of coins there. I mean, really, like the Bitcoin bottom was in November, but a lot of other coins, they experienced a bottom in March 2023. Good time to buy. Really good time to buy. But a whole percentage point. The 10-year treasury paid 1 whole percentage point less than a 2-year. And we're all like, well, that doesn't make no sense. Why would it do that? That's an inverted yield curve, which typically is a predictor of a recession. And all this time here, everybody was thinking, well, there's going to be a recession in 2024, which we didn't have. But got this inverted yield curve going on. And then later it uninverts in September of 2024, which I think was where we started getting like some positive price action for the year 2024. And then it goes all the way back up here to a spread of about 0.5%. Now, I think we should look at it a little closer here. Let's start this one over here in July. Look how wild this thing is. It's a very wild looking chart. Very volatile. The yield spread, a very volatile yield spread that we're looking at right here. All right. Fugly Googly, put your question back in at the end right there. I'll come back to that. I was like, if I answer it now, I'm going to get like way too sidetracked from what I'm trying to communicate here about this chart. This is a bull steepener, though, when it went from being uninverted when it went from being inverted to uninverted. And I say it's a bull steepener because the short-term interest rate dropped faster than the long-term. It's a bull steepener because it's a good thing that the short-term drops faster. We're returning to logic. We're returning to a normal world where good news is good news and bad news is bad news, instead of like the world where we've been living in where bad news is good news because we're waiting for enough bad things to happen for the Fed to start cutting interest rates. That was something that you would probably constantly hear way back during the inverted yield curve days of 2024. Well, bad news is still good news and good news is bad news. So, what's this bull steepener screaming? It's screaming that growth and inflation expectations, they're in the toilet. Forget that nonsense about like the treasury supply driving yields. Because you would think, well, if there's so many treasuries out there, and if so much is being issued out, well, shouldn't the supply with no growth in demand cause the yield to go up? Well, it could be, but here's the thing, is that Scott Bessent, our Treasury Secretary, he's not flooding the market with 10-year notes. No. So yields at the long end, they're going to be more about growth and inflation, not the issuance. But the 2-year, that Treasury yield was down, I think, 5 basis points. Let's look at that chart again here, or look at the Treasury again. Let's see, go back to Fidelity. What's the gap right now? Oh my. It's enormous right here. Look at this. You got 27 beeps from there, and then 28. Do like some quick math here. What's 27 plus 28? It's 56, right? Yeah, I think it's 56. Okay, so a whole 56 basis point spread between the 2-year and the 10-year. That is a bull steepener. So, I mean, like, growth and inflation expectations for the future are not good. And that has, like, a lot of people piling and plowing into the short-term treasuries as opposed to the long-term ones. All right. And you see, like, that 2-year treasury, it's dropping faster than the 10-year because the market is betting that the Fed is about to cave, that they're about to cut the rates. Nobody wants to buy these treasuries. Nobody wants to buy these treasuries here yet. Yeah. So a 25 basis point cut. We saw that has over a 90% chance of happening. And with Trump's team massaging the numbers to avoid bad headlines, I don't think that's really priced into the 2-year treasury yet. So we can expect probably the 2-year treasury going down a little bit more. Now, why am I covering this here? Like, what's the point of all this? Why do the treasuries matter? I'll tell you why. We want to go back to the CPI report. I like to call it the CP lie. That's what I call it, the CP lie. Because here's the thing, is like when you look at CPI, the way that they weight these things, they don't give these things the proper weight that it should. Because like the majority of household expenses for the average American, I think, is going to be, if it's not on the housing, or it probably all goes to housing expenses here, but groceries are a much bigger chunk out of a household budget than the CPI gives it credit for. I really don't like these numbers here, or I really don't like the 2.7 number that they give us here. And let's see, core CPI is up 3.1%, which is up just a tick. The base effects, that's a big deal. And Q3 and Q4, we could see big drops there. But if we keep getting like this 0.2% months against higher base months, well, then CPI could hit 2.1% or lower. That's great. That's what we want. And that's why yields are crumbling, because the market is realizing that all this talk about tariffs are causing inflation, they're realizing that that's all just a big load of bullcrap. The tariffs aren't jacking prices up as feared. And Goldman Sachs, they were banging on about consumers eating tariff costs. Well, that's not in the data. The food prices, you can see these foods are up. But overall, what's the food prices at? Let's see, it only up 2.2%. It's not that bad. It's not great. We don't want any inflation at all for food. But still, overall, it's not that bad. 2.2% is the total, which you see right at the top there where it says food at home, 2.2% in parentheses. Or how about new vehicles? Is that on this chart here? I think it is. Let's see, did I put it on here? Maybe they got, nah. I don't think that they got it on there, do they? Yeah. Well, it could be that like it's not on there because there was no inflation on it, which is the point that I'm trying to make here, is that new vehicles, zero change. And that's with Trump adding tariffs on Japan, on Mexico, and on Canada. I mean, like, who can keep up with the man's tariff roulette? Who can keep up with it? Now, used cars, they ticked up, but they also fell last month. So it's just a back and forth noise. The shelter, lodging, that's only up 0.2% because housing is starting to, housing's really cracking. It's cracking and probably going to crumble because you just got so many people that are never going to be able to own a home. So now your supply of buyers has shrunk tremendously. Transport medical services, they went up just a tiny bit, but not even 1%. So the headline's benign. And combine that with the jobs report fiasco, the market is slashing growth and inflation expectations. They don't think that there's going to be a lot of growth. They don't think there's going to be a lot of inflation. So what needs to happen is the Fed needs to cut the rates to juice the economy back. Producers, here's the deal. Like, why is this happening? Like, you talk about these tariffs being raised. but prices are not being raised with it. How's that possible? Because you'd think, well, if you put a additional cost on the producer, wouldn't they just pass those costs along to the consumer? In a normal world, yes. I mean, you don't want to be paying those costs as a business, so you raise your prices, right? Well, producers can't raise prices on consumers if the consumers don't have the ability to pay those prices. See, when I ran a laundromat, I could have raised my prices to $20 a wash. But if I did that, no one would use my laundromat and I'd go out of business. And when my gas costs went up, which they often did, because the dryers in a laundromat, they run off of natural gas, I usually had to just eat those costs. I couldn't just keep raising up my prices on the dryers because, one, that's a pain in the ass to have to go reprogram the price on all 20 of the dryers that I had. But then it'd piss some customers off and they would go to a competitor and they wouldn't come back. So I can't just do that. So there's no tariff-driven inflation. Why is that? Consumers are tapped out because the incomes aren't rising fast enough to absorb higher prices. So they're using credit cards, robbing Peter to pay Paul. The demand shifts. Some prices rise while others flatline, so it's a wash. And second, producers like Toyota are eating the tariff costs to protect their market share because they know Trump policies, they flip faster than the overarching plot line of the Star Wars sequel trilogy. They'd rather cut margins than lose customers, especially in a weakening economy. Zero Hedge, I saw this on Zero Hedge. They made an excellent point here, was that the new Bureau of Labor Statistics chief, Heritage Foundation fella, he oversees the CPI, not just the jobs data. Is he cooking the books? Well, maybe. The last person that they had that was juicing the headlines under Biden and Trump and later revised them down. The real problem is not politics. It's just the methodology that the Bureau of Labor Statistics uses is bad methodology. They keep reporting the unemployment rate, but you notice they never mention labor force participation, which is more important. They never mention that. So still, they expect rosier numbers ahead. That's just how the game is played. Yeah. The DXY, the dollar index, that's also driven by interest rate differentials. Hey, you know what? Wasn't there a guy that said the DXY matters and it's why crypto isn't pumping right now? Wasn't there like this really good looking guy? He sounded really intelligent every time he talked to that said, hey, like that DXY thing, it really matters and we should pay attention to it because it's kind of like part of the reason like why this bull run hasn't started yet. Oh yeah, I remember him. His name was Cairo Copeland. So short term, DXY matters. And long term, you want to look at that as like the global monetary system's plumbing because dollar is the world reserve currency. And when it comes to crypto, it's priced in what? Dollar bills. So the purchasing power, the strength of the dollar really matters when in determining whether the price of crypto goes up. But the market is pricing in faster Fed cuts. Pricing in faster Fed cuts than a month ago. All right. What does that mean for the assets? Gold, it's up slightly. Crypto, they loved this. Bitcoin popped all the way up to 124,000. Your alts had a little bit of a pop there too. Lower yields means that risk on assets like your Bitcoins, your Solanas, NASDAQ, and of course, your DeFi degen plays like PulseChain, like Sonic, they're going to get a boost. But the real thing to watch for, or thing I like to watch for, is oil, which I think they got it up here top, right? Do they? We look at futures and commodities. Energy futures, yes. Oil, unchanged from yesterday, but it's at 63.96. Why does that matter? Well, you see, energy is the economy. And oil is trending down hard. It's screaming that they think there's going to be weak demand in the future. When we say, like, the economy, was it run on? It runs on energy. So when oil is going down, that says growth is sputtering. That's backing up the jobs data, and that's backing up the yield moves going down. So what's the play? The Fed, Jerome Powell, is cornered now. You got weak jobs. You got tame CPI. You got dovish governors dissenting. And you got Trump's pressure. So cuts are coming, you guys. And that is going to be great. We're going to see some euphoric months ahead once these cuts start coming in. Big question now is it going to be a 25 basis point cut or a 50-point cut? Now, a 50-point cut, that could tank the short-term yields further and then boost crypto, boost gold. Don't wait for the pivot, because you see, you're going to miss the boat if you're waiting for that to happen right here. Now's the time to gobble up all those penny coins like I tell you to. And as you know, at the last Fed meeting, they didn't cut. But there was something else that happened. So J. Powell is going to keep cock-blocking the bull run, but this is the most bullish thing for risk-on assets for a long time here, because you see your Bitcoins, your Ethereum, your PulseChain, your Sonic, they're all grinning like they just hacked the Fed's printer. Because, ever since the delays started, the pause, where the Fed says, well, we're not going to raise rates, but we're not going to cut them. Ever since they stopped raising, they just said, we're going to pause. We've been up. And then last year, in 2024, they kept cutting all the way up until December. Bitcoin is up 23% since they delayed cuts from them. You see, what happens here is it's the longer you delay cuts, the more powerful an effect that they have. Right now, the Fed's kind of sitting on its hands, and Jay Powell is stroking his ego like a Bond villain, while the economy just keeps flashing more warning signs than ever, like a nuclear reactor in a B movie. And here's a sign that I don't think is getting enough attention. And to me, this is like a real telltale sign. Real telltale sign here that was, let's see, where did I put it? Yeah, over here. I hope y'all saw this chart here. You see this? This tells you how bad the economy really is. The share of young adults living with a parent. This over here, the year 1940. What was going on in the country back in 1940? That's right, the Great Depression. And here we are over right here. I mean, it was a lot higher with COVID, but it's come down just a little bit. But over here, where we're at, is the same rate that we had back in the Great Depression, 48%. 48% of young adults still live with their parents. That was unheard of in the 60s, all the way up until, I guess, the 80s here. I mean, really, like the best time to be alive, or I don't want to say that, not the best time to be alive, but like the best economic times that America had experienced besides the 1920s was the 1950s. If we just went back to doing what we did in the 50s, where we had 4% growth, man, we'd have a great economy and life would be so much better. And I know some schmuck out there is going to say, the 1950s were racist, before I can even get like one half of a breath out. That's always the case there. There's always some putz, some woke-tard college imbecile that goes, the 1950s were racist. Okay, then, well, can we take all of the other lessons from the 50s minus the racism and apply them to today? Can we do that? Apparently not. So, if we just went back to doing what we did in the 50s, because you saw it was going down here, we had a nice downward trend and hit bottom in 1960. But this here, I think, is far more frightening than anything that we saw over on CNBC, anything that we saw on Fred, on any of the other charts that we got here about inflation, or any of the charts about the treasury yields. This is a much more frightening thing here, because when you got people living with their parents, well, what is it? What else are they not doing? What else are they not doing? Somebody throw it in the chat here. What else is not happening when you live with your parents? Particularly you guys watching, you should be able to answer this question right away. When you live with mom and dad, what's something you're not able to do? What's the thing I get the most questions about? Cairo, how do I get the girls? You ain't getting no girls if you're living with mom and dad. You're not going to be dating. You're not going to be getting laid. You're not going to be getting married. You're not going to be starting families. This is like population decline. This is contributing to it right here. So it literally is all about the money. Because like when life is too expensive, you get less of it. When life is cheap, you get more of it. We made life too expensive for people to produce more life. This is a big problem. That's right, Condor, you got the answer right there. You can't meet no girl when you're living with your parents. Or you can't go out on a date with a girl when you meet your parents. Because, like, what if it goes good? And she's like, oh, man, I think you're just so incredibly cute. And you made me laugh so many times a day. Here, I want to go home with you. And they'd be like, oh, okay. Well, when we get home, we got to kind of like tiptoe in here because I can't let my roommates, I can't let them hear us and everything. And she'd be like, okay. And you get back there and you tiptoe in, but then, your mom steps out of the bedroom with her curlers and her moo-moo on, and she's like, oh, sweetie, what are you doing here? Who's this girl and everything? And it's like, oh, yeah, that's my roommate. Why are you rooming with a 50-year-old woman? So this really hurts the economy when you got this, because these people are delaying their progression in life. They're delaying becoming producing economic units or net producing economic units when they are living with their parents. Because you see, they're living with their parents for the fact that they just can't support themselves. So if they can't even support themselves, they're going to be helping the economy grow. How? They're not. And what's the thing that motivates men to get out and bust their ass and work hard? What's the thing that does that? The thing that does that is women and the possibility of sex. And if they live with their parents, they're not going to have any. So this should be the chart that should be in front of every Fed governor's face. And Jay Powell should be like, oh my God, this is a huge disaster. We need to cut rates immediately. The jobs report for July, that was a disaster. 73,000 jobs added, way below the 109,000 expected. The Bureau of Labor Statistics admits that they flubbed the numbers. They were revised in May downward, revised in June downward, for a total of 258,000 jobs that they didn't have. That's the kind of oops you only see when the economy is tanking faster than a submarine in a Godzilla movie. The jobs growth, it's averaging only a pitiful 35,000 jobs a month, which is below the 100,000 needed to keep up with population growth. The labor market is not just stagnant, it's shrinking. Manufacturing has been contracting for 5 months straight. And the tariffs and immigration chaos are gumming up supply chains. National hiring rates at its lowest since 2014. If you exclude the pandemic, of course, as there was a panic there. This isn't a blip. This is a neon sign that's screaming, hey, a recession is right around the corner. But Jerome Powell, he's still playing hard to get, like he's the last hot babe on Bumble, saying, oh, I need to be wined and dined for 20 dates before I put out and cut the rates. Why? Well, because the Fed's got the phobia of screwing it up again. Because they didn't just screw it up back in 2019. Back in the 1970s, they cut way too early, and inflation roared back, and they looked like idiots. Now they're terrified of tariffs spiking up prices, so they keep saying, well, we're waiting for more data. We're waiting for more data. More data is going to come along, and it's going to slap you right in the face. You're going to be too late. The bond market is not waiting. Remember what I said way back at the PulseChain conference, that we don't necessarily have to wait for Jay Powell to cut these rates because the market's going to force him to do it. They're going to beat him to the punch, possibly. We're already seeing that. The 2-year Treasury yield is dropping after the jobs report. And it's all saying, hey, September is the meeting where they're going to cut the rates. Goldman Sachs says, yeah, we think they're going to cut the rates for sure. Analysts like Tom Lee are shouting, yeah, it's undeniable. The market's priced in a high chance of a September rate cut. If Powell doesn't budge, well, then it's politics or it's ego that's holding him back. But here's the juicy bit that nobody's talking about. The Fed is cracking from the inside. Because you see, at the last FOMC meeting, 2 governors dissented. And it's the first split that we've seen since the 1990s. Not just central bank drama flashing its neon signs saying that rate cuts are coming. It's not just that. People at the Fed are fed up with Powell saying, oh, let's wait and see. They're practically begging him to pull the trigger before the economy faceplants. The Fed Governor Adriana Kugler, she just bailed out mid-cycle. She's not waiting for the end of her term. She bailed out now, opening the door for Trump to appoint a dovish crony. And with Trump leaning on the Fed harder than a bouncer at a dodgy nightclub, we're entering a new monetary regime, and one that's all about loose money and pumping the markets and juicing the economy for the midterms. They're going to pump this economy because Trump does not want to lose in the midterms. The Republicans don't want to lose in the midterms. They want stocks soaring. They want housing thawing. And yes, crypto to go bonkers. So the Fed, it's not pivoting yet, but the cracks are there. And when they do, it's going to be a fireworks show. Why is this bullish for crypto? These steady rate cuts are like catnip for risk-on assets. A gradual easing, like Goldman Sachs is predicting, that sends capital flooding into high-growth plays. Bonds get less sexy as the yields drop. So money rotates out of bonds and into tech stocks, into Bitcoin, Ethereum, Solana, and then eventually the super decentralized degen plays like PulseChain, like Sonic. Remember this thing that I showed you earlier, this one chart? Where did I put it here? Where's that chart? Oh, wait, not that chart. Hang on, I showed you that chart. It's going to be... Sorry, guys. This chart. Here was the first Bitcoin top. And then these green candles here was the 10,000X from last cycle. First Bitcoin pops, then the rest of the market. It's just the way it works, guys. It's just the way it works. All right. So, the slow cutting is really the sweet spot for risk-on assets. And then Ethereum could smash new highs. Because you see, quality layer 1s and DeFi, they surge. And I mean, even Dogecoin might moon. The bag holders, your time's coming. But you got to be positioned right now. Now let's talk about the regular markets. Like the S&P 500, it's on a V-shaped recovery ever since the April 2nd chaos where you had a 15% dip from the tariff panic. But you see, it's not the Mag 7 leading this time. See, all throughout 2023 and 2024, what kept the market afloat was the Magnificent Seven. That's your Teslas and your Amazon, Apple, Netflix, Microsoft. Big companies. They supported the entire stock market throughout those years. They're not the ones leading the way this year. Right now, it is the high beta, low profitability stocks like Coinbase, like Robinhood, or any startup that's got AI on its name. It's like .com mania vibes all over again. You remember like back in 98 to 2000, the high beta stocks went up 111%, while low beta lagged. Beta, what that just means is that's relative risk of an asset or relative volatility, like how wild the price goes, up or down. That's what we mean when we say beta in financial services. Today's rally, it really smells a lot like 1998. but with crypto and AI stocks leading the way. So what's the play? Well, don't wait for Powell to say the rate cuts. You want to start buying right now. If you haven't started buying, get a DCA going right now. Now's a good time for it. We haven't gotten to like the 2021 retail FOMO yet. It's the institutions and the corporates that are driving the bus, and they don't stop buying just because we hit 150,000. Bitcoin hitting 150,000. I mean, this could go a little bit into 2026. What we got to bear in mind here, though, is that the longer they delay those rate cuts, the more powerful the impact is that they have. So it could be a thing here where we get all of the bullish action in the last 4 months of the year, or really last 3 months of the year. It could happen because what happens there is like people make mad amounts of profit and they don't want to sell it until the new year turns around. But if you sell it before the new year turns around, you owe it on 2025's tax return. And they'd much rather wait till when they have to file the 2026 tax return, so they have a whole year to plan for it, or a whole year to move to Puerto Rico. That's possible. But man, we're going to have like a very good last couple of months of this year, I think. Now, what I want to do here for the rest of the program is I want to talk to you about like how does this bull run, map it out here. How does the bull run happen? How does it go? What keeps it rolling? I want to map that out for you guys so you kind of know like, well, what happens next? Why does it keep going up? I mean, how much more higher can it keep going and everything? I wanted to like show you the dominoes that play out here. So let's see. Let me get you a chart. We'll just use the Bitcoin chart here from previous cycles. All right. So set it over here to we should use the 2017 cycle because a lot of people think that is the one that this cycle is most like. Okay, getting it set here. Got it ready. Let me share my screen with y'all. Okay. So, this here is about the last 6 months of 2017. Really, last 5 months. Long before all this, we had the bottom. And long before all this, you have what is called the easy or early accumulation phase, where nothing's happening. Price stops dropping, though. But it's not rising either. It's just sitting there like a cat staring at you and silently judging you the way the cats do. This is when the market's equivalent of MI5 agents start building positions. They don't tweet. They don't brag. They just methodically hover up the supply while everyone else is watching Hulu and pretending they never heard of crypto. Then we get some catalysts, the first whiff of excitement. Some country legalizes Bitcoin or an ETF gets approved, or Elon tweets a dog emoji and everybody loses their minds. The press cautiously mutters that, digital assets might be on rebound, which is like announcing that a zombie might be coming back to life. But still, it makes a few hedge funds twitch with curiosity. Then we get the first leg up. And that's about right over here. First leg up, and it started occurring here in August. What's going on here in this first leg up? I'm going to talk that one out here with you. Okay, it's kind of where we're at right now. The price lurches upwards, but the bears are shouting, it's just a dead cat bounce, which is finance jargon for, I hope this fails because I sold everything. All the bears that you're hearing right now that are spreading that crap about, too many coins for us to have a pump this time around. This is them I'm talking about. They're saying, it's just a dead cat bounce. The cycle is long over. They think 124,000 is the top. Short traders, the short sellers, they bet on falling prices. They suddenly discover that their low-risk trades are about as safe as juggling chainsaws on a trampoline. And the margin calls happen, and the liquidations cascade, and somewhere, a YouTuber is wiping dust off of their webcam and getting ready to start streaming again. All right, now, short selling. You got to understand how short selling works here. If you don't know how short selling works, I'm going to give you an analogy, or I'm going to give you an example that is so easy, even a 10-year-old could understand it. Because I tell you, when I was 10 years old, there was a cartoon I like to watch called Johnny Bravo. I don't know if you're, I'm going to age myself here when I say that, but if you're old enough to remember Johnny Bravo, what did he like to do? Well, he wanted to impress the girls. He wanted to impress women. He was trying to get a date the whole time. He was trying to get laid the whole time, which is hilarious for a kid's cartoon. So he's running around going, "Hey, baby, why don't you look at my muscles and everything?" Now, let's go back to the olden days. By the olden days, I mean the 1920s, just before the Great Depression, like before they started regulating short selling. The way that it worked here is you'd have somebody like Johnny Bravo who's looking to impress people. And what he would do is, this was back in the old days when stocks were all certificate paper. They were all printed on paper. You have stock certificates. It's not done on computer because we didn't have computers yet. When you bought a stock, you got a certificate for your stock. And then you could take that and show it off to all your friends. Be like, "Hey, look how cool I am or how rich I am. I got this stock here." So imagine somebody like Johnny Bravo borrowing certificates from one of his friends and probably paying for the privilege of doing so. Just like renting a really cool car. You rent a really cool car because you want to go impress the girls and look hot, look rich. Well, Johnny Bravo, he is renting these stock certificates to impress the girls. And so he's showing them off like, "Hey, baby, look at all this stock that I got." And the stock that he borrowed is going up. And the girl's just like, "Oh, Johnny, what you should do is you should sell that stock and take me on a nice fancy date." And since Johnny doesn't think with his big head, he thinks with his little head, he sells the stock, forgetting that it's borrowed stock that's not his. And he takes the girl on the date, but of course, as always, Johnny Bravo says something stupid, insensitive, or offensive and gets himself slapped and a drink thrown in his face. The girl clutches her pearls and dips out. And then Johnny realizes, "Oh my God, that stock that I sold, it wasn't mine. It was my friend's that I borrowed. I got to get that thing back." But he can't get it back. He sold it. And the price is higher. So what does he do? He goes running around the exchange floor, talking all sorts of trash about the company, scaring people, and getting them to sell down their shares of stock, getting them to sell their stock certificates. Sell it down, push the price down, because each sell order pushes the price down. They keep pushing the price down, and so Johnny can now buy that stock back at a lower price, maybe even make some money here, like pockets the difference on it. Pockets the difference from what he sold it for when it was at a high price. Now he bought it at a lower price. He gives it back to the friend that he borrowed it from and pockets the difference. That's short selling. The thing you got to know about short selling is that every time someone does a short sale, they must, 100% must buy that thing back at some point in the future. People do short sales on crypto like Bitcoin and Ethereum, but when they open a short position, they have to, in the future, buy it back. And the buy order, when there's enough of them together, it pushes the prices up. When the price is already going up and you got these short positions, what happens is the broker that is hosting the short for you, or that you place the short sale order with, they say, "Hey, you know what? This stock that you did a short sale on because you thought it was going to go down, you were wrong, bro, because it's going up. And you might want to sell it right now because there's no limit to how high this thing can go up. It can go all the way up to infinity, and you got unlimited losses, and you're going to owe us money. And you know what? We don't even think you got the money, so we're just going to sell it for you." They call that liquidating the shorts. When shorts get liquidated, that means the asset is being bought back. And those buy orders are pushing the price up again. This is why crypto moves so volatilely, so violently all at once. Is when it's already going up, it tends to keep going up, and it goes up to like higher unbelievable levels. Part of that is the short sales get liquidated. And that brings us to step 5, the momentum builds. And then it's like the what if it really is back moment. The market breaks a key resistance level. So going back to our chart here for Bitcoin, we would say, well, that's probably right here. Right around here in the 2017 market in October. It broke a resistance level, and then boom, boom, boom. It kept going on up. What else is playing into that? What else is causing that? Everyone who sold their bags swears they'll just wait for a dip, but the dip never comes. And then institutional buyers, they smell blood. CNBC starts mentioning Bitcoin between oil prices and grain futures, and things start heating up. Then we got the mid-bull run frenzy, and here comes the morons. The so-called dumb money. Because you see what happens is you have mainstream headlines that say things like, oh, Bitcoin doubled in 6 months. And that gets the attention of the so-called dumb money. And that causes this leg up right here. Or probably this one right here. Yeah, I think probably this one. It's when retail arrives. And then also later on over here in November, definitely retail was arriving right there, pushing the price all the way up to 8,000. That's when your coworker who once bought Ethereum, or your coworker who bought something like Solana because a TikToker said it was going to 10,000. Right? It's when your mom calls you up and says, hey, I want to get into that thing that you told me about earlier, that Ethereum thing. I thought it was a sleep aid at first, but hey, I heard it's going up here. I want to get into it. And then the altcoins wake up. Meme coins erupt. And suddenly everybody is an early investor. And then we got this feedback loop going on where we get stupid rich, stupid fast. The early buyers' portfolios are now so inflated that they're throwing money at even stupider things. The profits from sensible coins like Bitcoin rotate into coins with names like Turbo Pepe 2.0 and causing bizarre 500% overnight moves. And that's also causing the altcoin season to blow up. It's causing Hex to do a 10,000x. And then celebrities are announcing NFTs. And then your grandma asks if she should get into, her words exactly, the Dogecoin. Should I get into the Dogecoin? And then we get the late stage parabolic run, which is the oxygen thin zone. That's this right here from the 1st of December all the way till the end of the year practically from the 2017 market. This final tick up all the way over here, which let me map it out a little bit more, where we almost cracked 20,000. And let's see, we had about 2 weeks left in the year when it did that. So about 2 weeks before the end of the year, we almost crack 20,000 in Bitcoin. And that's when the price charts are going vertical now. Like the price chart's just one big vertical green candle. Every day is a new all-time high. That is a warning sign there for you. When every day is a new all-time high for a couple of days, pay very close attention. You want to be glued to your computer with your MetaMask open. Because the funding rates in futures markets are so high, you'd think people were paying rent to be long. New projects are now raising billions of dollars with just a PowerPoint presentation and a Discord server. And you know the good part? When you start planning which Lamborghini color matches your aura. And then the final part, the blow off top. And it happens in one day, practically. One day where we just have this unbelievable return. Absolute mania, and CNBC starts running a Bitcoin ticker on screen 24/7. Starbucks baristas are discussing their Polygon bags. You buy something ridiculous because, number go up. And whales, the people who bought at step 1, they quietly start to dump their holdings into a sea of over-leveraged retail buyers. And then that's when the crash happens. That's when the bear market begins. So why am I going through all this here? What I want you to understand from all this is how fast things can turn around. This is how powerfully it can turn around. And this is just how awesome everything gets all at once. I want to show you a video that kind of captures the essence of that. I want to show you a video that illustrates it, I think, best here, where first you have your recency bias, you have your confirmation bias to the negative. And then when one little thing changes, that causes a chain reaction of dominoes going in the positive direction, and then the recency bias and the confirmation bias starts to work in your favor. So I have that for you here on my channel. I want to show this to you. Check this out. You only live once. For most of your life, you will be stressed and poor. Do not believe that financial freedom is attainable. I'm here to tell you that it's impossible. It's a lie when they say you can retire young and wealthy. The truth is, you have to be connected to even have a chance. Do not believe that hard work pays off. All you need to know is the same tired excuses. You can never have opportunities to improve your life. In this world, all I see is suffering and cynicism. Do not expect better days are ahead. Instead, know this. Better days are ahead. Do not expect suffering and cynicism. In this world, all I see is opportunities to improve your life. You can never have the same tired excuses. All you need to know is that hard work pays off. Do not believe you have to be connected to even have a chance. The truth is, you can retire young and wealthy. It's a lie when they say that it's impossible. I'm here to tell you, financial freedom is attainable. Do not believe that for most of your life, you will be stressed and poor. You only live once. All right, so that is going to be the direction of Reinvent Ideal for this channel, for the website, for the Substack, all those things. And I'll show you that here to show you just like, once it turns around, everything that was working against you before starts working in your favor. I'm talking about the recency bias. Like recency in the bear market, it's nothing but bad. But once it turns around, well, recently everything was good, and that just keeps going in that bias. And confirmation bias starts to work in your favor because it has been going up for a while. New investors think it's going to keep going up. And things play out where shorts get liquidated, when it attracts the eyes of institutional buyers, when it attracts the eyes of countries that want to have a strategic crypto reserve. Once that happens, everything starts going good. Everything turns positive. It stays positive for a while. And I think it could be concentrated all into the last 3 months of this year. It'll be a very unbelievable 3 months. It's going to be a very long 3 months, too, because it'll be like, oh my God, a new all-time high here, a new all-time high there, and everything. It could bleed over a little bit into 2026. Don't know exactly when it's going to end. Don't know exactly when. I mean, there will be signs, though. Because in 2021, I keep repeating this here because this is how angry I am at myself for not taking this as a sign that, hey, we hit the top. There was a Instagram thought, an Instagram model that said she was using Ethereum to pay for her Brazilian booty lift. All right, when a stupid bimbo like that knows about Ethereum, yeah, we probably hit the top right there. All right. Now, I made a promise to all you guys earlier today that I got a free gift for you. Let me show you. Where did I have it here? Yeah, free gift for you. This book right here, Your Parents Were Wrong. You can have this book for free. All you got to do is just do one solid favor here for me. One solid favor, and that is this here. If you subscribe to my Substack, it does not cost you anything to subscribe to my Substack. All the articles on there right now are free. If you want to be a paid subscriber, I appreciate that. And you get more free books if you're a paid subscriber. I'll send you more. I'll send you an email with the links to them. So if you just want to be a free subscriber, you get the book called Your Parents Were Wrong. If you want to be a paid subscriber, you get that book plus one other. And if you want to be what we call an idealist, which is an extra special subscriber, let's see, is it going to let me see it here? I don't think it will let me see it. Well, let me just put in an email here. This is my public email. Let's see. Does it show us there? It doesn't show. If you want to be what we call an idealist, that's this one. Just had it there. Okay, hold on a second here. Sorry, don't subscribe to my own thing here, so I don't know exactly how this works. Let's try that again. So, when you subscribe to it, you get a choice of what kind of subscription you want to have here. And one of them is Idealist. And Idealist just means you are paying a little bit more. And if you do that, you get three free books. Total of 3 free books. So everybody can get Your Parents Were Wrong for free. You can be a free subscriber here on the Substack. But then when it comes to like when I eventually do paid posts several months out, you'll get those if you're a paid subscriber. But right now, you get more free books from me. Get a total of 3 of them if you want to be an idealist. That really helps me out. All right. So that was everything I wanted to cover here today. We can spend a little bit of time here on questions. I know we had some questions in the chat. So go ahead and throw them in there. Be happy to answer them for you there. And while you all are typing them in here, let me go get another drink. It was one I saw earlier that was about... what was the one I saw earlier? Yeah, Kirill asked, will you explain why it's important to be silent about getting mad gains? Yes, I will explain that. And when I do, take that as your sign that I think the top is in when I give you that speech. Cairo, can you give us your prediction? Or you gave us your prediction of $7 EHEX in one of your previous streams. Can you give us predictions on PulseX and Inc? I can't. The reason why I can't do that is this here is they haven't existed before, so I got no frame of reference for it. I mean, they could do anything. They could do anything at all. So I can't really give a prediction on that. I can give a prediction on EHEX because we've got a track record for EHEX and we got a track record for Ethereum that it runs on. We don't have one for a PulseChain. So really, PulseChain could do anything. Who knows? And, especially if, like, Ethereum pumps really hard, like Richard thinks it does, and he does what he said he was going to do in that clip with Eric Wall. If he does that, if he takes the profits from Ethereum and plows them into his coins, his core coins on the PulseChain network, who knows what it could do? I think they would do better than EHEX just because of the liquidity is low. The liquidity is low, and that chain was made for those assets, whereas Ethereum was not made for Hex. Anybody got anything else? Anything else at all? No dumb questions here. No? All right. So, you guys will see a lot more of me in the near future. We're going to be doing a lot more streaming, taking YouTube a lot more seriously. Hope you enjoyed and learned something here today. Until then, we'll see you in the next stream. And you'll also be seeing me put up a lot of videos on the channel there, too. I know, like, you want to see, like, the live streams and everything, but we'll also be making videos here on financial literacy and financial freedom. Just kind of like the one that you just saw, but more informative and more instructional. So, we'll see you then. Cairo out.